Hey there, everybody. Just coming on a little bit early today so that I can test out my tech. So just hang in there with me for a few minutes. That light is like blinding. Oh, okay. We have the slides. Okay. Stay put. We're going to be on in like 5 minutes. Okay, everybody. Are you loving that? Listening to my gardeners? Of course, on webinar day, the gardeners are going to be there. It's fabulous. Oh, and I'm looking at the slide and we have a little bit of an error, so that's cool. All right. Hey, everybody. Welcome to my first webinar on DSCR. And if you are a current real estate investor or if you're someone who's thinking about being a real estate investor, this is something that you're going to want to just kind of pop in and pay a little bit of attention to because these loans are really making it easy for people to become investors. So welcome. Let's go to slide 2. First and foremost, what is a DSCR loan? Like, I know in the mortgage industry, we talk in all these acronyms. So let me kind of let you know what we're talking about. A DSCR is a debt service coverage ratio loan. What the hell does that mean? That means when they are looking to approve this loan, when they're underwriting this loan, they are underwriting it based on the rental income on the property. So usually when you fill out a loan for an investment property, they're going to look at your personal income and they're going to use that in with projected rents, of course, to see if you qualify for the property. In these loans, they're not looking at your income at all. They're looking at your credit, they're looking at your assets, but they're not looking at your income. They are looking at the ability of the property to rent enough to cover the mortgage payment. Make sense? So who is a DSCR loan for? Honestly, they're really good for just about anybody. You can do it as a purchase. You can do it as a refinance. You can do it even if you've never been an investor before. So if you don't own a home at all, like first-time home buyers can do this. They need a little bit more down and there's a little bit more stipulations, but you can. So, for a lot of people here in California, this conversation that we're having, we're pre-approving them. They're not able to pre-approve for the amount that they want in an area that they want. So they're looking at buying investment properties. Get in the game somehow. So they're buying an investment property, they're putting a renter in the investment property, and then sitting on that investment property for a little while, accruing some equity, and then taking that equity to buy the home that they want to live in. So who is a DSCR loan good for? First-time home buyer. You can buy in an LLC with this, which is important because a lot of times, if you are an investor, you might have partners and all of it's in an LLC. We can do that. Long-term leases, short-term VRBOs. Again, every different property has different qualifications, so we definitely want to ask, but all of that can be done with the DSCR loan. the most important thing, and it kind of seems like a no-brainer, but it can't be a primary residence and it can't be a second home. So you can't do a DSCR loan saying, hey, I'm going to rent out a room to someone. It doesn't work that way. This has to be a straight across the board investment property. What kind of properties can you buy? So you can buy a single family home, you can buy a 2 to 4 unit property, you can buy a condo, you can buy a townhouse, you can buy a VRBO. So again, lots of opportunities, lots of easy ways to get your foot in the market. We talked a little bit about this. You do not have to be an experienced investor. This can be your first rental. This can be the way you get your foot in the game. This can be the first property that you even buy. Not every lender does that, so we do have to kind of look around a little bit, but there are ones out there that will allow this to be you. So if you are that younger person who wants to get in the real estate game and you can't afford your area, maybe you live in a very high cost area, but you can buy something on the outskirts and put a renter in there, this is your jam. Buy them, put the renter in there, let it ride for a little bit, take that equity, and then buy your dream home in a couple of years down the road. What are they looking at to qualify? So this is not a low down payment program. You're not getting down payment assistance on this. You're going to need at the minimum 15%. It goes up from there depending on quite a few things. Credit is still very important. You got to have a good credit score. You have to have the down payment. You have to have reserves. Reserves are going to be very important with these loans of all types. They want to know that if you don't have a renter in there, you're able to cover that mortgage payment. And those reserves are going to be anywhere from 3, 6 to 12 months, depending on the program that you choose. And lastly, the property. Is the property gonna count? That's the most important thing, obviously. If the bank's going to be hesitant to lend you money where the mortgage payment's $5,000, but the rent's $1,500. I mean, that doesn't even make sense on paper. So you definitely want to make sure that the numbers cash flow. And that is what we can do for you. If you're interested in looking at a property, you give me a call. We kind of run the numbers, what the mortgage payment's going to be, what we think we're going to rent it for, and we can find out before you even go look at it if it's going to be a viable property for you. So how do they figure out if it's going to cash flow? This is the math. So basically, you're going to take your monthly rental income and you're going to divide it by your monthly principal, interest, taxes, insurance, the payment on the house. So in this 600 example, they bought it, they're buying for 600, they're putting 20% down, they're carrying a loan of 480, the interest rate is 8. Yes, the interest rate is 8. I don't think I mentioned that to you, but the interest rates are higher on this. Again, interest rates are based on risk, and this is a little bit of layered risk. Number one, it's not a primary residence. Number two, we're not even looking at your income. Very low doc loan, that's going to be more risk. So 8s, 9s, even maybe closer to 10 if your credit's not great. So the payment on this one is going to be $3,500 principal, interest, taxes, or $4,297 principal, interest, taxes, and insurance. The rent's only going to be $3,500. So this one doesn't cash flow exactly. It comes out to a 0.81. There are programs that most of them will go to about 0.75 or higher. So, and again, obviously, the more that it cash flows, the better the interest rate. But just kind of keep in your back of your mind that 0.75 is the threshold for most DSCR loans. I am being told there's ones out there that don't have any sort of a threshold. I don't know about them. If we run into that situation, I'll find it. But I would just say, as for rule of thumb, As for rule of thumb, let's shoot for 0.75 or higher on the debt service coverage ratio. We just talked about this. So yeah. Yes, sub 1% is available. There are no ratio options out there. Again, we can go down that road if you find something. But, as an investor, here's the thing. Do you want something that's going to not really cash flow? I can understand taking a little bit of a hit. But, in the long game, you do want to sit and you do want your property to appreciate, but you also don't want to be forking out a whole lot every month to cover that mortgage payment. So that's something that we will dig into as we go through and just kind of make sure this makes sense for you. So if you find something that is not cash flowing right, what can we do? So you can look at more money down. You can look at buying a house in a different area where the rent's going to be higher. You can look at buying something for a lower price. There are other options out there. The thing is, just about everybody's doing this loan right now. So there are a ton of different banks. There's a ton of different ways to structure the deal. Your biggest things that you need to worry about, if this is a path you want to go down, are credit score and reserves, and finding something that moderately cash flows. So let's break this up into myths versus reality. So you do not need years of experience as a landlord. This can be your first investment property. This can be your first property. We talked about this. The rent does not always have to cover the payment. You can go below and even. You can go up to 75%. Apparently, you can go even farther than that with no ratios. Let's just be careful. You don't want to set yourself up, again, to be offsetting a rental payment every month. The borrower does matter. Like it is important. You have to have credit. You have to have assets. You have to have reserves. You have to be a strong borrower profile to buy with one of these loans. And no, you cannot use this loan for a home that you live in. It's investment properties only. So if you find something that you are interested in and you want to kind of get an idea if you're going to qualify, this is what we need. We need the property, the price, what you think it can rent for, or what the real estate agent thinks it can rent for. We're going to need to know what your credit score is. We're going to need to know and see your assets. We're going to need to know how you're vesting. Are you going to be buying it yourself, or are you going to be buying it in an LLC? We are going to need to see your money. We need to know that you have the down and the closing costs, and that you have the reserves after the down and the closing costs are paid. And then basically, once you go into contract, they'll do the appraisal. They'll order what is called a rental survey, which means it's like a mini appraiser. An appraiser tells you what properties in that market are renting for. And then if there's currently a lease, like if the property already has a tenant in it, we need to see that lease agreement. Or if you have a projected tenant, we need to see that lease agreement. I just said this. So basically, this is what you need to do. If you're interested in one of these properties, that's what I need. I need the address. I need what we're paying for it, how much we're putting down, and what we think it can rent for. Oh, your actual photo here. Okay, well, my actual photo is there. So I didn't catch that when I was doing when me and chat were working on this, we didn't catch it. Anyways, so that's kind of it, guys. That is the debt service coverage ratio loan in a nutshell. It is a fantastic loan for an investor. These close quickly. They close easily. I can do these in 48 different states. It's, just a great way to not only get in the game, but build on your portfolio. Again, the biggest things that you want to watch for are make sure you have the credit, make sure you have the money, and let's make sure that you're not going to get into a negative cash flow situation on the property. If you have any questions on any of this, go ahead and send that information to my email or text me, and I would be happy to run some numbers for you. All right, guys, have a great day. Next week's Tuesday webinar is going to be all about mobile home financing. And goodbye.